Hey guys, and welcome to this Friday's video. Now in this video I want to talk about the wealth triangle, and more specifically I want to talk about how do you actually attain wealth through trading. Now firstly, in order for you to build wealth you must understand that there are three things that you need. The first thing that you need is time, the second thing you need is money, and the third thing is to know where to spend your time and to know where to put your money. Now, there is a relationship between time and wealth and money and wealth. You see, the earlier you start, the greater chance you have of actually attaining wealth. And the later you start, the harder it's going to be for you to actually attain wealth, meaning that you have to work a lot harder. Now, when it comes to money and wealth, the relationship between the two is that of when you have a sufficient amount of capital, the easier it is to actually start building your wealth. But if you don't have a sufficient amount of capital, the longer it's going to take. So essentially, when it comes to attaining wealth, if you have a little time, then you're going to have a lot of money. And if you do not have a lot of money, then that means you're going to have a lot of time. So when it comes to attaining wealth, you must understand that either you're going to pay through time or you're going to pay through money. And if you want to shorten the amount of time it takes to build wealth, then you're going to have to shorten it by having more money. But if you do not have the money, you're going to have to sacrifice a lot more time. So the question is, how does trading fit into this entire process? Well, to address this question, we first have to address the myth about trading. You see, in order for you to be a full-time trader, and when you are drawing an income from trading particularly, you must understand that your account size is not necessarily what gives you your income. The interest that you're getting from your account is giving you your income. So, in other words, your account needs to be of that size that when you are making a profitable trade, that the profits that you incur from that trade is large enough to facilitate your monthly expenses. Now, it's fair to say that if you put in $100 in your trading account, 1% of that is not necessarily going to facilitate your monthly expenses. Let's alone putting in $1,000, a return of that is not going to facilitate your monthly expenses. And so what you come to discover is that when you're truly trading full-time and you're trading for a living, then what that means is that the amount of money that you put into your account and the returns you're able to get from that investment is subjected to the amount of capital that was invested in the first place. So let me put it to you this way. 1% of $100 is very different to 1% of $1,000, and 1% of $1,000 is very different to 1% of $10,000. So you see where I'm going with this. You cannot put in $100 and make a 2% return and expect that 2% to facilitate your monthly expenses. And so what you come to find is that you're going to need to have a sufficient amount of capital in your account so that when you make your return, when you make 2% or 3% for the month, that 2% or 3% is big enough to facilitate your monthly expenses and maintain your standard of living. Now, when it comes to trading, very few people actually addresses this reality. And a lot of people enter trading with the mindset that all I need is $1,000 or all I need is $100, and that is going to be enough for me to take out money. Now, to compensate for this, what they do is they put in a little money and they increase the risk. So when they increase the risk, they ultimately reduce the amount of time it's going to take to grow that account. The problem with increasing the risk and reducing the time is that you increase the probability of blowing the entire account. Whereas on the other side, the other alternative is to actually, in order for you to reduce the time, you have to increase the invested capital. So if you want to reduce the amount of time, you, instead of increasing the risk, you actually have to increase the invested capital. And if you cannot increase the invested capital, you have to lengthen the amount of time. Now, when we address that part of trading, when I speak to my students, one of the things I mention to them is that when you are on your journey to becoming financially independent, the moment you use your trading account as a vehicle towards financial independence, it's very important to know how to navigate your way with that particular account. And so One of the things I want to do is take you to a very, very simple exercise and show you the numbers and show you how this particular approach will allow you to attain passive income, but at the same time reduce the risk in the process. So with that being said, guys, let's jump over to the computer and have a look at these numbers. Okay guys, so we're jumping over here to our compound interest calculator, and I like to use this calculator to explain these concepts with my students. So we're going to start off and I'm going to put a total in here, and that's going to be 30,000 Rand. Okay, now the reason I'm using Rand is because I am in South Africa and we obviously our currency is Rands, and so 30,000 Rand is not an easy amount to come by. It's actually quite a substantial amount of money. And so for a lot of people, this might be quite extreme. But like I said earlier, in order for you to reduce the amount of time, you're going to have to increase the amount of money. And if you cannot increase the amount of money, you're going to have to increase the amount of time. Now, with that being said, let's say we're starting off with 30,000 Rand. Now, 30,000 Rand is not going to be the amount of money we need to open a trading account that we can use to trade full time. And we won't be able to live off the interest return that we're going to be getting from this account. It's way too small. So we have to build this particular account to a account size that allows us to earn interest. And when we earn that interest, it's going to be enough for us to reinvest, and as a result of that, live off that interest. So we're moving ever closer towards financial independence. And I'm going to be elaborating on that in the next point. But for now, let's go ahead and continue with this example over here. So we've opened a 30,000 Rand account, and we're saying that our annual target is going to be 30%. Now, for a lot of guys, I understand that this might be a very, very small return, and this might be a good month for some traders. But I'm trying to be as conservative as I can possibly be to make this as relevant as I possibly can make it to the average person. And essentially, with this information, we're saying that 30% per annum means that this is 2.5% per month. Now, 2.5% per month is not something that you can reach every single month, but you may have a good month. For example, you may have a 5% month, which basically buys you 2 months in advance. So what we're saying is that that's going to be our annual target, and the calculation period, we're saying this is going to be traded for the next 10 years. Now I understand 10 years is a lot of time, but we're going to come back to this example shortly. So once we have that confirmation, we can go ahead and click calculate. Okay, so now once we've calculated, we can actually see that our 30,000 Rand investment after a 10-year period with a compounded interest of 30% per year turns into 580,000 Rand. Now, this is a substantial amount of money in a 10-year period. Now, in order for us to get this amount of money and reduce the amount of time, we are actually going to have to go ahead and increase the amount that we're investing. So instead of us investing 30,000, we are actually going to have to invest 120,000 Rand into this particular account. And that will allow us to get a 30% annual return over a 5-year period instead of a 10-year period. So let's see what that total comes out to. So you can see after 5 years, we can get around just below the targeted amount. And obviously, this is in half the time. So like we said, in order for us to reduce the amount of time, we have to increase the amount that is invested. And that's the objective of this exercise. So what I want to do is I want to go to the second point and discuss what do we do with this amount of money. So I'm going to go back over here and put in our 30,000 Rand investment and say that this is going to be over a 10-year period, and that's going to be the amount that we're going to work with. Okay, so you can see that we're going to be working with 580,000, and we're going to work with that moving forward. So our next phase is going to be the investment stage. Okay, so as you guys can see that after 10 years, our 30,000 Rand investment turned into more than 500,000 over a 10-year period. Now, that again might seem like a lot of money, but notice how long it took us to get there. And like we said, guys, although the time was longer, if we wanted to shorten the amount of time, we would actually have increased the amount of money. Okay guys, so when we talk about the investment stage, this is what we do after we have accumulated the desired amount of capital. Now, when we have this 500,000 plus, we can either decide that we want to continue trading it, but like I said, that doesn't really mean financial independence, because ultimately we're still working to earn an income from this amount that we built. The objective is to take that investment and reinvest it in what we would call a high interest bearing account or a fixed interest bearing account, and basically have a institution trade or invest that capital for us. And the returns that we'll get from that amount is going to be what we receive passively. In this instance, we've worked for 10 years to grow this account, and now what we're going to do is we're going to take that capital and we're going to reinvest it in a high interest bearing investment. Okay, guys, so now we are in the next stage of our journey to financial independence. And so, what I did, I typed in high interest bearing accounts and I got Alexander Gray over here. And they gave us the highest annual return was 12.8, and the lowest annual return was 5.2. Now, bear in mind, these are not massively impressive, but these funds manages billions of billions, and so it is quite an impressive return in and of itself. But what we are trying to do is we are actually trying to shift the responsibility. We are actually trying to shift the workload now from us no longer trading the account, and we're using the money that we've grown and we're going to reinvest this into an account that is going to be managed by an institution. Okay. And what we're going to do is the first thing I want to do is kind of calculate the average. You can see that they had the highest annual return was 12.8 and the lowest annual return was 5.2. So if we were to calculate the average, and again, guys, I want to be as conservative as I can possibly be, 5.2. And let's say, just hypothetically, that they're going to give you an average annual return of 7.6% per year. So what we're going to do now is we're going to jump over back to our compound interest calculator, and we're going to take our amount of 580,000, and we are going to put it in Alan Gray, sorry. And what we're going to do is we're going to put in their interest rate per year. And we are basically going to live off the interest that we're going to get from this initial investment, because every year they're going to give us 7.6%. So when they give us 7.6%, that's going to be what we earn every single year, right? So if I go here and I put in 1 year, then we're only going to get for that year's interest alone 45,706 Rand. Now, if I go and calculate what that will be per month, then what you will come to discover is that it's not necessarily that much. It's going to be 3,808 Rand. Now, this is passively. Remember, we are not working to get this amount of money. This is just coming into our accounts with little to no effort, and we're not doing any work at all. But that is after 1 year. So when we take this money out, the account will go back to its defaulted amount, which is 580,000. And next year we will take the same amount out because it's a standard 7.6% return on average. Okay. Now, what we want to do is we want the institution to grow this account. We want Alan Gray to grow this account for us now. By doing that, the risk is dramatically reduced, because now we are not only managing in FX, we are managing and we have a diversified portfolio through Alan Gray. And so what we're saying is that we're going to give them another 10 years. Okay. So we took 10 years to grow this account, and we're going to allow them to grow this account for the next 10 years. And we calculate that. And remember, the next 10 years, we leave it. We do not touch that money. We don't touch that money. Essentially, they are growing it to that amount over there. They're going to be growing this for the next 10 years. And after 10 years, you're going to see that your total balance is going to be about around 1.2 million. And if you take that 1.2 million and now you calculate, this is going to be the annual interest every year of that amount. So if we go ahead and calculate what can we get per month after achieving this interest rate per annum. So if you take 90,386 Rand and you divide that by 12 months, what you come and find is that now your passive income is going to be 7,332 Rand every month for the rest of your life, as long as your money is with Alan Gray and they are giving you this interest rate. And guys, what I want
to kind of address in this example is that this is the true definition of passive income, because for the rest of your life, you will not be working, you will not be doing anything, you will only be getting this amount of money because you put your money with an institution that is going to give you these returns every single year. And that's going to be what you do. You can literally sit at home and earn money doing absolutely nothing. Now, again, like I said, this is a total of 20 years, where after 20 years, you're going to get 7,532 Rand every single month for doing absolutely nothing. But it took you 20 years to get here. Okay. If you want to reduce the amount of time, you're going to have to increase the amount that you invest. And that is going to take us to our next point.
So as you guys can see, it takes a lot of time to build wealth. Indeed, it is a marathon and it is not a sprint. And so if you truly want to become financially independent, if you truly want to prosper, you have to trade. You have to trade an account, and you have to grow this account, and the proceeds of that account has to be invested. And once you've invested, you invested in an institution that will now carry forward what you have started. And after they've carried it forward to a point where you can now earn a living off the interest that you're getting, essentially what that leads you is to prosper. And so you prosper when you are trading, when you are investing, and that will lead you to prosper. And that is our tip. That is our tip for wealth. That is the wealth tip that we share with you. Understand that the reason I worked with a 7,000 Rand plus return per month is because on average, that is what the average South African will earn. And this is the entry level for many organizations, and essentially this is what a lot of families are living on, 7,000, 8,000 Rand between that two. And a family that earns that amount coming in passively, that they're not doing any work for that, and still, because they're only working, that's only the first 20 years of their life that they've given to that, they can afford to work the next 10 years, working a total of 30 years, and growing that even more, because now they can invest even more, and as a result increase the passive income even more. There's so many different ways you can view this, and I'm not trying to communicate the numbers. I'm trying to use the numbers to communicate the concept. The concept is, and the principle is, that there is no shortcuts to wealth. There is absolutely no shortcuts to wealth. It's either that you reduce your time by increasing the investment or the invested capital, or you increase the time by having a sufficient or affordable amount of capital invested in the first place. Do not ever increase the risk. The moment you increase the risk to reduce the time, then ultimately you risk losing all of the invested capital and you start all from over. So this is how I would suggest people attain wealth. This is how I would suggest, and this is the process that I would recommend people follow. Essentially just using these key simple concepts to kind of direct your path into financial independence. There's a very famous saying by Tony Robbins, and he says that people are rewarded in public for what they practice for years in private. There is no get-rich-quick scheme. There is no shortcuts. If you truly want to find success, it takes time, it takes dedication, and it takes a massive amount of commitment. So guys, I really hope that you found value in today's episode. I look forward to hearing your comments, and I look forward to hearing your feedback with regards to this particular exercise. Furthermore, I hope that you have an awesome weekend further, and I look forward to chatting to you all soon. Up until then, cheers and bye for now.